I'm Wong, Director of Phillip Securities Hong Kong and Fund Manager of PhillipCapital Management Hong Kong. Today, I will share with you our views on the outlook of China Asia and the Hong Kong market in the third quarter. Okay, this is the risk disclaimer that I need to show. Okay, these are the key discussion points that I will share today. First of all, we will go through a review of China, Asia, and Hong Kong market. And then we'll also look at analyze China's economy, how it will, the outlook in the second half. And last time, I remember the e-seminar I did for PhillipCapital Singapore. We focused on the new economy stocks listed in Hong Kong. So this time around, we will also take a look at how these new economy stocks fare amid the coronavirus spread, the pandemic. I will also follow up on previous topics to see whether our last recommendation do bring investment returns to investors in Singapore. And then last but not least, I will share with you the stock picks this time. Okay, review of China, Asia, and Hong Kong market. In the first half, actually, Asia market outperformed the Hong Kong market. The Shanghai Composite Index was only down 2.2% in the first half as at 30 June. Actually, entering the second half, the Asia market, the Shanghai Composite Index saw a breakout of the 3,000 resistance level. Now it's trading, Friday closing was 3,150. So the Shanghai Composite Index has actually made a breakout of the key resistance level. This is the first point I wish to point out. And then Hong Kong market was plagued by not only the pandemic, but also by the social protests that's going on in Hong Kong. So Hang Seng Index underperformed by dropping 13.3% in the first half. Okay, but entering the second half, we saw a slight improvement in the Hong Kong market. Hang Seng Index closed at 25,400 yesterday, 25,000. And you can see from the chart, since March, the Hang Seng Index rarely closed above 25,000. So this is the first time that it managed to close about 25,000 at around 25,300. Okay. In terms of valuation, the Shanghai Composite Index was currently trading at around 15 to 16 times historical PE. This is the 10-year average PE band of the Shanghai Composite Index. So the black line in the middle represents the fair value of the Shanghai Composite Index. So the fair value is around 14.3 times historical PE. Now it's trading slightly above the fair value, but still below the +1 standard deviation, which is around 17 times. And in terms of index level for the Shanghai Composite Index, the +1 standard deviation equates to around 3,350 points for the index. So now the Shanghai Composite Index is between the fair value and +1 standard deviation. Okay. For Hong Kong market, because of the confidence level, it's still trading below the fair value. The fair value will be around 11.2 times historical PE, which is around 26,250. 26,250. So now it's trading at around 10.8 times, slightly below 11 times PE, around 25,300. Okay. Overview of China's economy. As we can notice, a lot of the economic indicators actually show improvement in the last 3 months since the beginning of the year. Fixed asset investment, the decline continues to narrow from a decline of 24.5% in the first 2 months. Now the decline narrowed to 6.3%. And actually, if you look at the 1 month FAI, fixed asset investment, in May, it actually rose 5.87% from April. So from a month-on-month comparison, actually it's already in positive grounds. Total fixed asset investment in highways and waterways increased 2.3% in the first 5 months, driven by investment in infrastructure. And also another silver lining is investment in high-tech industries increased 1.9% in the first 5 months, rebounding from the 3% drop in the first 4 months. Okay. Among fixed asset investment actually comprise 3 major components. That is infrastructure investment and manufacturing investment in manufacturing, and property investment. So property investment is actually the most important anchor for fixed asset investment in China. For the first 5 months of the year, property investment fell only 0.3%, far less than previous months as the economy begins to slowly emerge from its coronavirus shutdown. And for May, for the month of May, real estate investment actually rose 8.1% from a year earlier, also accelerating from the 7% growth rate in April. Okay, this is partly attributable to property sales rebounding in May. You can see in this chart, the yellow line represents property sales by floor area. The blue line represents property sales by value. So from a decline of more than 30% in the first 2 months, now the decline decelerated, narrow, eased to around between 10% to 12%. Okay. For the month of May, actually, property sales by floor area increased 9.7%, which is the fastest pace since July 2018. So it's about 2 years, the fastest pace in 2 years, and compare with a 2.1% fall in April. In terms of value, commercial housing sales jumped 14% in May. Okay. As at end of May, because of property sales rebounding, so unsold new homes, the housing inventory, floor space of unsold new home decreased by 4.83 million to 570 million square meter as at end of May, as compared to end of April. Because property sales are improving, so developers are spending more to acquire new land. Developers spent a combined 242.9 billion yuan in the first 5 months, up 7.1% year on year. And compared to the first 4 months, it was up 0.2 percentage points. So property sales are rebounding, fixed asset investment decline narrowing. And then we look at the confidence level of property developers represented by the Property Development Climate Index, this so-called 国房景气指数. For the index level, if it stays at 100, means property developers are generally quite optimistic, quite upbeat about the outlook. Below 100 means they are a bit conservative. And if the index drops to 95, that means they are very bearish, they are very downbeat. So now we can see a rebound in this climate index from a low of 97.42 to currently 99.35. So very close to the 100 level, the neutral level. Okay. The 3 growth drivers of economy are fixed asset investment, retail sales, consumption, and external trade. So these are the three growth drivers for economic growth. So retail sales also saw significant improvement in the last few months. You can see here a drop of 20.5% in the first 2 months, now narrowing to 2.8%. Which sector is worst hit? Understandably, it's the catering sector. Restaurants are being shut down, so revenues of the catering sector, one of the worst hit industries by COVID-19, fell 18.9% in May. But on the other hand, the decline managed to narrow by 12.2 percentage points from April. But one silver lining among retail sales is online shopping, because a lot of people have to stay home because of the shutdown. So people spend more on online shopping. Online shopping continues to boom with a 4.5% increase during the first 5 months. Just now I mentioned the third growth driver is trade, external trade. China, this is the trade surplus, and the red line represents the import, black line represents exports. Exports decreased only by 3.3% in US dollar terms in May, helped by an increase in medical-related sales, a lot of face masks. So China exported a lot of face masks and other medical equipment targeting the COVID-19 in May. So this helped exports to just decrease 3.3%. However, imports plunged 16.7% along with commodity prices. So that resulted in a trade surplus of 62.93 billion US dollar just for 1 month. So this is a record month for China's trade surplus. Okay. Now let's look at factory activities, the manufacturing industrial output. So actually industrial output runs ahead of the three growth drivers I mentioned. You can see that in April, value-added industrial output already turned positive, growing 3.9% in April and picking up to the growth rate picking up to 4.4% in May. But in the first 5 months, industrial output was still slightly down, went down by 2.8% year on year, with the rate narrowing 2.1 percentage points from the first 4 months. As of May 27, this is a lot of people are concerned about the resumption of production. So as of May 27, about 67.4% of the survey enterprises were back to 80% of their normal production levels, up 6.6 percentage points from later April. But one may ask, now with the second round of outbreak of COVID-19 cases in Beijing and certain areas in China, will it affect manufacturing activities in the next 3 months? So this remains to be seen. We'll monitor the situation more closely in terms of industrial output. Also, we saw a rebound in industrial profits. So May industrial profits post first monthly rise in 6 months, improvement in industrial profits. This chart, there are two lines here. Yellow line represents the revenue of industrial enterprises, while the blue line represents the profits, industrial profits. So for a cumulative angle, the first 5 months, industrial profits of China factories still down about 20%, But if we look at the single month of May, industrial profits actually went up 6% from the same period last year, comparing to a 4.3% decrease registered in April. And this rebound was attributable to factors including ease pressure on costs, because raw material costs has dropped even more. Commodity prices have dropped earlier in April and May, and price change of industrial products. Some industry enterprises are able to raise price slightly, and the profit improvement in key industries such as petroleum processing, electricity, and water supply. Okay, consumer inflation has been a concern for a time. You can see here, because of soaring pork prices, CPI, this is the year-on-year comparison, this is month-on-month. CPI rose at a rate of 5.4% in January this year, topping 5%. But since then, we saw a gentle moderation of the CPI consumer inflation. So in May, consumer CPI eased to 2.4%, which is a 14-month low. Recent also due to pork price and food costs moderating. And then PPI continues to drop because of the impact from the COVID-19. So decline in prices at the factory gate also deepened to a 4-year low as oil prices slump. But as the previous chart shows, this does not have a negative impact on industrial profits. Actually, industrial profits improved slightly because raw material costs dropped even more than the prices at the factory gate. That the prices of end products dropped less than the price of raw materials. Okay, recent PMI are quite encouraging. We look at both the official purchasing manager index and the Caixin market purchasing manager index. So this one is the official one, released by the National Bureau of Statistics, China, NBS. A sharp rebound from February, rising back to the 50 level. 50 is the threshold between expansion and contraction. So when the index say above 50, that means expansion. Now you can see in June, the official manufacturing PMI picks up from 50.6 to 50.9. Non-manufacturing PMI also picks up from 53.6 to 54.4. Okay, so these are the two official PMIs. Look at a comparison with the Caixin, the private PMI. The Caixin market manufacturing PMI also saw improvement in June. Came in at 51.2 in June as compared to 50.7 in May. And the services PMI rose to 58.4 in June compared to the previous month. Compared with the previous month of 55, as the easing of the pandemic lockdown measures revive consumer demand. Okay, so this is the overall overview of China economy. We saw the economy recovering from a previous lockdown, but one has to be very careful about the future development, whether there is another outbreak. Barring a severe outbreak again, we are still upbeat about the second half outlook of China's economy, and we do expect more easing, for instance, monetary easing by the PBOC in the next 6 months, including reducing the RRR, the reserve requirement ratio, and moderately cutting interest rates. But we don't expect aggressive interest rate cuts as in the West. China is also, the PBOC is concerned about too much liquidity that may cause speculation in the housing market and also the stock market. Okay, Last time we focused on the new economy stocks. So let's look how new economy stocks are say amid this COVID-19 pandemic. This is Ali Health. I remember in my previous presentation in Singapore, we singled out 8 new economy stocks, and namely Ali Health, PA, Ping An, Good Doctor, Tencent, Alibaba, Meituan Entertainment, and China Literature, Zhong'an Online, and Ping An China. So we'll cover these companies and see how they fare during the pandemic, the outbreak. Ali Health, wow, tops the list, up 1.7 times in the first half 2020. I think it's one of the major beneficiary of the pandemic, because a lot of people cannot leave home. So if they fell sick, they need to seek online consultation, and also they may need to buy pharmaceutical products, drugs online. So this is favorable. This is positive to Ali Health, which provides online pharmaceutical sales as well as online medical consultation. Okay. The other company that also performed very well is Meituan, 3690. It was up 76.6 in the first half. Actually, it continued to rise over the last few days, because it's also seen as a beneficiary of the pandemic, because a lot of people, a lot of restaurants are, a lot of restaurants cannot take eat-in customers. So more people turn to delivery that benefit Meituan. Although the other business outfit, Meituan has 2 major business outfit. One is delivery, and the other one is online booking of hotels, air tickets. So this business line inevitably is affected by the coronavirus, but the delivery business more than offset the adverse impact on the other business line. Okay, Xiaomi was only up 19.1% in first half 2020. I think because the business nature is still not seen as 100% internet company or new economy company, because a lot of the revenue of Xiaomi still comes from the manufacturing of hardware, such as handsets and TV. So it underperformed other new economy stocks. But recently it managed to break above the 14 over the last 2 days. We saw a breakout of the $14 resistance level. But we are a bit conservative on Xiaomi because of its involvement in India. India has become the second largest market for Xiaomi behind China. But because of the recent friction, the China and Indian relation, that the tension between China and India, it remains to be seen whether it will affect Xiaomi's business in India. Okay, of course, not all new economy stocks did well in the pandemic. There are a few exceptions. What are the exceptions? Meituan Entertainment 1896 was actually a victim of the pandemic. The share price was down 17.6% in the first half because its main key business is online ticket booking platform for people to buy cinema tickets, and they also extend their service to concerts. But the pandemic caused a lot of nearly all cinemas in China to shut down, to be shut down. So there's no, it affects the revenue and as well as the earnings of Meituan Entertainment, and the share price was down 17.6% in the first half. up to now, there are no clear signs that cinemas in China are allowed to reopen. I remember in March, they announced that cinemas may be allowed to open, but after just 1 week, they came out with another announcement to ban the opening again because of the pandemic. Okay. Its competitor, Ali Pictures, owned by Alibaba 1060, was also victimized by the pandemic. So the share price was down 24.8% in the first half this year. Okay, so you may wonder why I have left out the leaders, Tencent, Alibaba, and Good Ping An Good Doctor. Why I have left them out? Because these are the stocks. If you remember, in my last presentation in Singapore, I recommended 3 stocks, namely Ping An Good Doctor, Tencent, and Alibaba. So let's look at the performance over the last 6 months and the last 3 months. Ping An Good Doctor was up 1.2 times, nearly 1.2 times in the second half. Same story as Ali Health, because more demand for online medical consultation and also online pharmaceutical sales. We recommend, at the time we recommended PA Good Doctor in March, the share price was around between $80 to $90. Now it's trading at 120. So those who have bought this stock after our recommendation should have a very handsome profit. Tencent was up 34.9% in the first half, but actually, if you look at the second quarter, its share price rose from around 350 to currently is trading at 520. 520. So it was also a beneficiary of the pandemic because it's believed that a lot of people who stay home spend more time playing online games. And Tencent recently also very aggressively promoting its online games overseas in the US and in other parts of the world. One game I was told, PUBG, I really don't know how to pronounce whether it's PUBG or PUBG. It's very popular in overseas. Okay. Alibaba, however, a little bit disappointing. The share price was up only 1.2% in the second half of 2020. But we think a break out of the 228 resistance level is quite likely. Now, actually, this is up to 30 June. Over the last 2 days, its share price now is trading, has risen towards $220. So the previous peak was 228. So we expect a breakout of this resistance level in the short term. The reason for the underperformance, as a lot of people may be aware, is due to the overhang from the fear that SoftBank, one of the strategic shareholders, has the intention to dispose of its holding in Alibaba. So this still becomes an overhang on Alibaba. But we do believe that once this overhang is removed, Alibaba, there's still a lot of upside for Alibaba to catch up. Our medium target for Alibaba is 240 Hong Kong dollars. So those who have bought Alibaba, we recommend we recommend them to continue to hold the shares. Okay. What are the stock picks we recommend this time? There are 2 stocks we recommend. Both are new economy stocks. The first one is ZhongAn Online. ZhongAn Online, the stock code 6060. These are the financial highlights of the company. So it registered rapid growth in gross written premiums, GWP, during the last 5 years, from only 2.2 billion yuan in 2015 to 14.62 billion yuan in 2019. So there's many-fold increase in the GWP. In terms of in the PRC, property and casualty insurance market, it ranked 11th. But in terms of internet non-auto property and casualty insurance, it ranked number 1 in the China market in terms of GWP in 2019. However, the company is still loss-making. But net loss attributable to shareholders narrowed to 454 yuan in 2019 from 1.74 billion yuan in 2018. This is the the overall loss. If we look at just the insurance part, its insurance business has actually turned profitable. So in 2019, it served close to 500 million users out of the 1.3 billion, 1.4 billion population in China. It served close to 500 million users and underwrote more than 8 billion policies. And its comprehensive solvency margin ratio is among the highest. Among the highest among China insurers, exceeding 500%. Okay, what will be the future growth driver? So it's providing targeted services through new scenario channels. For instance, it's actively exploring new online scenarios that leads to a growth of 5 times in the business volume of its proprietary platforms as compared with 2018. So it's selling insurance on 2 online channels. One, its own proprietary platforms. The other one is third-party platforms such as Taobao, Tianmao. One can buy insurance from Zhong'an through other online platforms such as Taobao and Tianmao. The difference is in terms of gross profit margin. For the third-party platform, the gross profit margin is lower because they need to share the commission with the third-party platform operators. But for the proprietary platforms, they don't need to share the income, so the gross profit margin is higher. For 2019, the portion, the percentage of business GWP from its proprietary platforms only account for 7.6% of its total business volume. So we expect going forward, we'll see higher percentage from its proprietary platforms, and that will translate into higher gross profit margin for the company going forward. And because of new growth drivers brought by new scenarios, GWP generated through its proprietary platforms last year exceeded the mark of 1 billion yuan. It also has enhanced strategic cooperation with Ant Financial because of its relationship with Alibaba. So it has a strategic cooperation with Ant Financial under Alibaba and other ecosystem partners to actively explore product innovation and upgrade, achieving a year-on-year growth of 1.3 times in GWP from the lifestyle consumption ecosystem business. Lifestyle consumption ecosystem business is closely related to e-commerce in China. So people who buy on the e-commerce platform are always very fearful of buying counterfeit goods. So they have this insurance against counterfeit goods provided by insurers such as Zhong'an and online. Another growth driver will be the promotion of digital transformation of insurance ecosystem around the world. So it's now exporting InsurTech. It's known as InsurTech. That means technology related to insurance to both the domestic and overseas markets. And last year, this business arm recorded a revenue of 269 million yuan, from the technology export, representing a year-on-year growth of 1.4 times. Now it's providing system products to 36 customers in insurance industry and a total of more than 260 customers in different industries. In terms of overseas customers, so now it's cooperating with SHCOMP, the third largest Japanese consolidated insurance company in Japan, and also NTUC Income. You will not be unfamiliar with. This is the largest property and casual insurance provider in Singapore, and also with Grab to provide users with customized and usage-based insurance products. For instance, its cooperation with Grab, it has issued over 5 million policies, and it has underwritten over 5 million policies by the ecosystem business of Grab. So when you use Grab, actually you may be indirectly actually using the service provided by ZhongAn Online. And last year in December, they launched the first virtual bank in Hong Kong. They got a license from the Hong Kong the Monetary Authority, and they were the first to launch this virtual bank in Hong Kong. Okay, the share price actually very volatile. It was listed in 2017. The listing price, take note of the listing price, was 59.7 Hong Kong dollars. So actually currently it's trading at around $40. Last 2 days it went up quite a lot. I hope if I can give this presentation earlier, before 30 June, then the price was trading between 35 to 38. Now it's already 42. Just last 2 days, its share price saw a big jump, but it's still below underwater. It's still trading below the IPO price. So our near-term target for the company is 48 Hong Kong dollars. We recommend to buy at $35, but based on the recent strength, one may need to adjust the buy price a little bit, maybe to close to $38. And the medium-term target, 48 is our near-term target. The medium-term target is the listing price, 59.70. And the stop loss would be 31 for a buy price of 35. If it is adjusted upwards to $38, then we will recommend a stop loss at 34 or 33 Hong Kong dollars. Okay. The other new economy stock that we recommend this time is China Literature, Yuewen Jituan, stock code is 772. These are the financial highlights of the company. Its revenue increased by close to 66% to 8.34 billion yuan for the year ended December 31st on a year-over-year basis. Its revenue comes from 2 parts. Online business, including online pay reading, those subscribers who pay to read the novels and other literary works on its platform, and also online advertising, advertising revenue from its online platform, and distribution of third-party online games on its platform. This is the online business. The other business line is intellectual property operations, IP. The authorization of the use of its IP to third party, and then it generates revenue for the company. So in the first half, you can see revenue from online business accounted for less than 50% of the total revenue. It amounted to 3.7 billion yuan, decreased by 3.1%. I'll explain why there was a decrease later. But revenue from IP operations accounted for more than 50% of the total revenue, 4.63 billion, increased by 2.8 times, very fast, very rapid growth. And profit attributable to equity holders increased by 20.4% to 1.09 billion yuan last year. Okay. There are other numbers, important key numbers to take note that reflect steady growth in their writers and also works of literature. So for a platform like China Literature, I think the key for success is you must have a lot of writers, and there must be a very diversified library of literary works. So they will attract more users, more subscribers. And with more subscribers, then you can attract more writers and resulting in more literary works. So this becomes a kind of a virtuous cycle for the platform. As of December 31st last year, its library featured 8.1 million writers. Wow, that's more than the population in Hong Kong. And 12.2 million works of literature, including 11.5 million original literary works written by writers on its platform, and 400,000 works sourced from third-party platforms, and 280,000 ebooks. But one more important thing, key thing is you have to be popular. Despite you have a lot of literary works, if they are not popular, it will of no use. So according to Baidu's February 2020 search rankings, among the top 30 online literary works, 25 were created on Yuewen, on China Literature, on the platform of China Literature. So that shows that actually is content, is literary works are quite popular among the readers. Average monthly active users increased from 213 million in 2018 to 219 million in 2019. Monthly ARPUs increased by 5% from 24.1 yuan to 25.3 yuan because of enhancement of the depth of content operations, optimization of the recommendation system, and expansion of content distribution channels. But ARPU was quite low. If you look at the ARPU, only $25. So this pay model, pay to read model may need a change. So actually, it's entering a transitional period, which we think is positive to its future, its prospect, its outlook, because it's now evolving the business model by introducing free-to-read services, which allows price-sensitive users to read the literary works for free. So you may ask, how does the company manage to make money from providing free service? One way is by monetizing through advertising. This is one way. The other way I did not mention here yet is by the IP, monetization of IP, of franchising or authorization of IP. So this free-to-read model directly complements the existing paid content model and offers a greater breadth of content and serves a broader range of users, thus broadening the user base and diversifying the monetization channels. In the past, the main source of income comes from the subscriber fees. That's why when you remember I showed earlier in my earlier slides, is online business revenue dropped by 3% in 2019. It's mainly because of this change of business model, because they have introduced free-to-read services. So that cause the revenue that affects that cause has an impact on the online business revenue. So cause the online revenue business to drop. But we expect this to be a temporary impact. Because by licensing IP operations, we expect the company to be able to earn more from IP operations. Licensing IP for adaptation into other content formats such as films, TV, and web series, animations, and games. So it's quite broad, the adaptation. There are many forms of adaptation of their IPs. In 2019, around 160 literary works were licensed to third-party partners for adaptation. You remember I mentioned just now, last year, at the end of last year, they have more than 12,000 literary works. So actually this 160 accounts for very little percentage of the total library. So going forward, if more literary works, they are able to license them to third-party partners for adaptation, this will mean more higher earnings revenue growth for the company. And they are cooperating with high caliber partners across the entertainment industries that results in growing library of adapted films, TV and web series, animations and games, amplifying the value of its IPs. This IP-centric monetization model will help prolong IP life cycle of its IP. Because in the past, if they don't, they don't go into adaptation of IP, the life cycle of the IP will remain only with the readership of the literary works. Once the readership declines, then the IP life cycle may come to an end. But now with adaptation, a certain novel can be made into films or TV series or web series. Well, then it can prolong the IP life cycle and also help the company monetize across various different formats. Okay, this is another area it's expanding into, the audio market. It has formed a strategic partnership with Tencent Music, which is a leading online music entertainment platform, the largest online music entertainment platform in China, to expand its presence in the audio market. Now, I think a lot of people, they don't like reading because it's quite taxing on their eyes. So they prefer listening, the audio books. The strategic partnership allows Tencent Music to produce audio books for China Literature. And these audio books will be made available on both parties' platforms. So they also can expand their reach to other users through Tencent Music. This collaboration will enrich the audiobook library of China Literature with very little cost. They don't need to invest a lot into building the audiobook library because they can leverage on Tencent Music, which is a sister company also under Tencent Group, and expand its content user base, further diversify its monetization methods, and in turn attract more writers to its platform. This is the virtuous cycle I mentioned. With more users, you will manage to attract more writers. With more writers and more output, more literary works, you will manage to attract more readers and users. Okay. The company is also expanding overseas. Web novel is foreign language website. I'm not sure if you are also a user of the web novel website. Grew very steadily, generating about 36 million visits in 2019. As of end of last year, web novel over nearly 700 literary works translated from Chinese and 88,000 original literary works in English and other local languages. Now it's expanding in Southeast Asia and other emerging markets where the market is still underdeveloped, penetrated. So in Singapore, it has entered into a strategic partnership with Singapore Telecommunications to jointly develop online literary services and content platforms. In Thailand, it has invested in OKBU, a leading online literature platform in Thailand, to better explore opportunities and penetrate the Thailand online literature market. And in emerging markets, it has formed a strategic partnership with Transsion Holdings, which is a leading smart device manufacturer and mobile internet service provider in emerging markets overseas, to expand into Africa, which is still largely untapped. the online literature market in Africa is still largely untapped. Okay, so our its listing price is 55 Hong Kong dollars. You can also see similar performance as compared to ZhongAn Online. It was listed in 2017 at a listing price of 55 Hong Kong dollars. Briefly, it went up to $90, close to $100 shortly after the listing. However, its share price saw a consistent decline since 2017 and bottomed out in 2019 last year. Now it's trading at around $52, $53, still slightly underwater because the listing price is 55. So we expect the share price to be able to go up to its listing price and beyond its listing price. So we recommend a buy price of 49 Hong Kong dollars, target price of 63, and stop loss can be placed at 43 Hong Kong dollars. Okay, so that's the my sharing on the Hong Kong and China stock market, and also the two stock picks at this time for you to consider. Now let's come to the Q&A session. I'll answer some of the questions written in here. Let me see, there are 30 questions already. How do you think about Chinese domestic bank stock in Hong Kong market in the second half year? I'm neutral. First of all, it seems to be, it will outperform if you compare Chinese domestic banking stocks with Hong Kong banking stocks or international banking stocks such as HSBC, Standard Chartered. Then I think the Chinese counterparts, the Chinese banking stocks, will outperform because it's more resilient. The Chinese economy, as I show you just now, is more resilient compared to Hong Kong and also other countries, other economies. But why I'm neutral is because China is still also on a easing trend. The Central Bank of China is also adopting an easing monetary policy, though at a very moderate pace, not as aggressive as Euro and the US. So a low interest rate regime will be less favorable for Chinese banks, and also problem loans, non-performing loans, will still be on a rise. I mean, there's chance for non-performing loans to rise slightly because of the economy. But I think overall it's under control. It's manageable. This bad loans situation in China is manageable. So we are neutral. But now most of the Chinese banks, such as the four state-owned Chinese bank, ICBC, China Construction Bank, they are trading at below 1 time PE. So it's very, in terms of valuation, it's very defensive. And in terms of dividend yield, most of them yield more than 5%. So I think it's good for income-seeking investors. But in terms of upside, the share price upside, I don't expect a lot of upside, maybe between 8 to 10% in the second half, because of the more stable or low growth earnings growth rate because of the low interest rate regime. Okay, what is the possibility of Baba and JD being put into Stock Connect? When might that be? I think it's just a matter of time. They will, these two stocks will be included into Stock Connect. But they have to clear the regulatory hurdles, because Baba and JD, they are under the different voting rights mechanism. So they have still to clear regulatory hurdles before they will be they will be included into the stock market. But I think this is just a matter of time. So you can buy in anticipation of that to happen. Okay. Um, Okay, with the stock price at all-time high, is it still okay to invest into Tencent and Alibaba if I intend to hold the stocks for the next 6 months? What is the target price? I mentioned Alibaba just now. Alibaba, I think, is still underperformed compared to Tencent and Meituan. So Alibaba, I think this price level can still go in. My medium-term target is 240. Tencent is a little bit overpriced at the moment. It's a bit overbought. So we recommend to go in if there's a correction in the share price when it drops below $500. So 490 to 495. This is recommended entry level. Okay. China Ping An was always considered a big white horse, but this year is badly falling behind compared with other new economy shares. Is this a good time to invest China Ping An now? Yes, I think the answer is yes, is positive. But let me explain why, try to give a reason why it underperforms. Because insurance company also is victimized by low interest rate regime. Not only the banks who fall victim to low interest rate. Insurance company, because of their investment in deposits and fixed income. So with interest rate going down, the investment return of insurance company will be affected. But now I think there's a change, turning point. Because A-share, just now I mentioned, we expect this, I forget to mention our index target for Shanghai Composite Index and Hang Seng for this year. Currently it's trading at 3150. Our target for this year, the highest index target is 3350. So that means there will be another 200 points upside to 3350. Best case scenario, it may go up to 3,500 if there are, say for instance, COVID pandemic comes to an end, and then there's a continuous V shape recovery in the economy, then best case scenario will see the Shanghai Composite Index rising to 3,500. For Hang Seng, our target this year is 27,000 to 27,500. Still more conservative because of political uncertainty that's surrounding, affecting Hong Kong. Okay, now let's come back because why I mentioned A-share, because insurance company, the investment return are affected. There are two variants, two key variants affecting the investment return. First, interest rate, interest income. The other one is investment in equities market. So the return from the stock market. With A-share market now recovering, showing upside movement, I think insurance, not only China Ping An. You see, China Life also seems to come back to life recently. The share price even outperformed Ping An. So I don't see any reason why Ping An will underperform China Life with all its exposure in fintech. Ping An is more exposed to fintech than China Life. So I think it's a good time to invest China Ping An now in view of its underperformance. Okay. Can you advise on Tencent? I already replied that just now. If there's a correction back to 490 and 495, it may be another good entry level. Okay. 1448 does still have room to grow. 1448 is Fu Shouyuan. Fu Shouyuan is a cemetery and funeral service operator in China. I think the company is okay lah. There's still room to grow, but if its share price like in June, its share price rally too rapidly, then you see a correction in the share price. Because aging population will be good to the company with higher death rate seen in China, and also its revenue comes from two sources: the provision of funeral services. But provision of funeral services are under regulation, are regulated, so you cannot at your own will raise your service charge. But the sale of cemetery slots, because now it's very scarce, because of the scarcity of cemetery slots. So this is one positive prospect for the company. And it has a large land bank, so-called like property developer is a property developer for the deceased. So it has a big land bank for the deceased. Okay. Will US cause Hong Kong back to drop due to security law? My view may be, just my personal view, because the Hong Kong dollar is pegged to the US dollar under the MA, the Monetary Authority in Hong Kong. So the Monetary Authority pledged to buy Hong Kong dollar, one Hong Kong exchange for $1 US for 7.8 Hong Kong dollars. So as long as the Monetary Authority in Hong Kong, they have sufficient US dollar, because they print money also on the US dollar reserve they have. So why they managed to, why is pegged? The peg mechanism behind the peg mechanism is this pledge to exchange Hong Kong dollar for US dollar. So as long as Hong Kong MS is able to upkeep this pledge, or there's no move to repeg or unpeg, then I think the peg will stay there. Okay. What is top pick company sector post COVID-19? Catering. I think catering. Just now I mentioned catering is hard hit by the COVID pandemic. So some of the fast food operators in Hong Kong, I think they may see a rebound in earnings as well as share price. Two companies in mind. One is Fairwood, 大快活, stock code is 52. The other one is Cafe de Coral, 大家乐. These are two Chinese fast food chain in Hong Kong, very stable and very resilient. Okay. How will trade war affect China? I think I will not spend too much time to answer this question, because it is not an easy question to answer, because whether the Sino-US relation will improve or deteriorate is still uncertain at the moment. So it's uncertain how the trade war will affect China. But we can see China now with the opening up of the economy, domestic consumption will be able to at least shore up the economy. Of course, with increase in exports, it will fasten the economic growth. But even with domestic consumption for the time being, I think it will be able to shore up the economy. Okay. This I also this question with the threat of U.S. withdrawal of preferential trade status as well as sanctions on Hong Kong, what will happen in your opinion to the financial landscape of Hong Kong? So far, we don't see any. As you can see, property prices. I mean, over the last, it's still very. I mean, the U.S. just announced the sanctions a few days ago after the 1st of July. So it remains to be seen. It's still too early to say to assess the impact on both the financial landscape and also the property market. But so far, as we can observe from the stock market, you can see stock market responded actually quite positively. I mean, to a lot of people's out of a lot of people's expectation, the market actually went up instead of going down. So I think it remains to be seen. And also some of the sanctions announced by the U.S. and also Canada are meant to be temporary in the announcement. So there's some room now, it seems to me. They want to leave, I mean, the door open, whether they want to impose more. Of course, there is the risk of more sanctions, or they would lessen it going forward. Okay, what indicators did you use in technical analysis? This is a good question. I think this is the first question I ever come across about technical analysis. I use 3 major indicators for my TA, namely the moving average. I put a very simple moving average. I look at the 5 key moving averages: 10-day, 20-day, 150-day, 100-day moving average, and 250. For certain markets, they use 200. But for Hong Kong, it's more commonly, the 250-day moving average is more commonly used. Okay, this is the first TA indicators I often use. The second indicator I focus on is the volume. Because volume speaks a lot. A rally without volume is maybe is not sustainable, not persistent. So volume, and the third indicator I always rely on is relative strength index, the RSI, because the relative index also reflects, tells the strength behind a rally or behind a sell-off. So they are quite reliable in my personal adoption of technical indicators. Okay, what's the outlook for JD Hong Kong? Why is the price not moving up much? I think the US share price has gone up, run ahead before the listing, the dual listing in Hong Kong. So after the listing, because its share price has already gone up, the US share price has already risen ahead of the, so it has front run a bit of the dual listing in Hong Kong. And also Alibaba is a major competitor. Also, the share price is not moving a lot. So I think when Alibaba finally managed to break out of the 228 resistance level and started to show strong momentum, then I think JD will follow. Now both are still in a consolidation, a pre-breakout mode. So one has to be patient. Investors have to be a little bit more patient, have to have more patience. Okay, what about Huawei? Huawei is not listed. So I think now is it will still face a lot of sanctions as well as hurdles to its overseas expansion, especially in the 5G arena. But it's not a listed company, so in terms of investment, there's very little for us to talk about. But its competitor ZTE is listed in Hong Kong. So ZTE always seen as a proxy to Huawei, because Huawei is not listed. So people may choose to invest in ZTE if they are bullish on Huawei, thinking that both will benefit from the 5G development. But honestly speaking, ZTE in terms of profitability and in terms of the size, it actually pales. It lags behind Huawei, and the earnings is very the financial results are quite volatile in the last few years. When it comes to sanction, ZTE also will has fallen victim to foreign sanctions in India and also in the US. Okay, what are your recommendations in China stocks for the next 2-3 months? I think I already have some stock picks just now, but ETF, you can, if you concur with our view on the Shanghai composite index that we have set a target of 3350, or best case scenario 3,500. Then I think A-share ETF is a simple way to profitize from expected rise on the China A-share market. Okay, is it better to buy Alibaba US stock or Hong Kong stock? It depends. It depends on which is cheaper because it's different time zones. So actually also not easy to compare, because Hong Kong, it may close at, say for instance, $220. Then US, it may go up or come down. So it depends on which is higher. So it depends on the price difference. Okay, now it's approaching 4 o'clock. So I will answer, this will be the 3 more questions, and then we'll end our seminar. Okay. Given that ZA online has gone up almost 84% in the last 3 months, do you still see a good growth momentum for this stock? Yes. If you look at the RSI, I mentioned, and also the volume, the trading volume, I think the momentum is still picking up steam. Its momentum is still picking up steam. If you compare to other new economy stocks such as Ping An, Good Doctor, and Ali Health, which has risen more than 1 times. So I think there's still upside. There's still room for ZA online for the share price to rise. Now it's still underwater, under the listing price. Okay, what are your views on Hong Kong REITs, like Link REITs? Neutral to slightly bearish, honestly speaking, because we don't expect a quick recovery to the commercial property sector in Hong Kong. We expect now with this pandemic going on, a lot of the shopping malls, the occupancy rate is dropping, and the rental renewal, when rental renewal upon rental renewal, there's downward pressure on the rental. So we are neutral to bearish, slightly bearish on REITs. On REITs. Okay, last question. What is the view on MTR? Is it a good defensive play, bearing in mind the ongoing riots? Okay, MTR, the revenue actually is quite diversified. Of course, one key source of revenue source is from the tariff collected from the people's trouble, people's ride on the trains. Second source of income is from rental, because MTR is a property plus train model adopted, in Hong Kong. So it gained the development rights of the property above its station by investing in the railway lines. So through this model, MTR is able to recoup its investment in a quicker and faster manner. So the property development brings it generate two kinds of income for MTR. One is rental. So for the property development model, normally they will through auction, through bidding, they will appoint a property developer to develop the properties above the certain station. And then the development, because it's very huge, normally there will be a big shopping mall. So after the completion, they will sell the units, and then they will do profit sharing with the property developer. Normally it's a 50-50 sharing with the property developer. And then they will retain the shopping mall for their own for the ownership. And then this is for long-term investment property, so they collect rents from those shopping malls. So for MTR, and also they also collect rents from the shops inside the station. So MTR, there are three sources of income, major source of income. One, tariffs. The other one, rental income, and property development income. So as for the tariff income, actually has already is recovering after the riots, and even despite the pandemic. Now every day I take MTR. It's very busy, as busy as it was. So tariff, I think there was a recovery, expected recovery to its previous level. But rental part, we're not as optimistic as upbeat, because I mentioned just now my comment on the REITs outlook that rental will be under pressure for at least the next 1-2 years. Will under pressure. So this part will be weakened. As for property development, I think so far the property market in Hong Kong, because of the supply, the scarcity in supply, is still very resilient, very stable. So property sales, our primary sales, still very, very robust and still very good. But people may ask, after this change in the legislation, will we see more offer on the secondary market? That means more people selling their homes. Remain to be seen now, because it's not happening yet. Not sure. I'm not sure whether this will happen or not, or whether there will be enough take up, enough demand to mitigate the supply. So for MTR, I think I'm neutral. It's defensive, but the rental part will weaken the defensiveness a bit. Okay. So thank you for your time. There are, wow, let me see, there are how many questions we have not remained. Maybe we'll do another short e-seminar to answer all the remaining questions, if time allows, and if my Singapore colleagues can arrange. So thank you very much. One last one, because I saw just one more question that I think I must answer, because I feel very strong about, I have strong feeling about this question. What is your view on Hong Kong Exchange? The share price has soared recently. Is it still a buy at the current price level? Now, Hong Kong Exchange, normally its share price will go along with the stock market. When there is a bull market, when the trading volume increases, the share price of stock exchange, Hong Kong Stock Exchange, will also go up in line with the performance of the stock market. But now I think there are new catalysts to its earnings as well as share price. There are two major catalysts. One is with more dual listing expected from Chinese companies listed in the US. Currently, only three were listed on the Hong Kong EX, namely Alibaba, Jingdong, JD.com, and NetEase. So it's expected that, of course, not all the Chinese companies listed in the US, Hong Kong Exchange will accept them, their dual listing application. So it's expected about 30 to 40 will ultimately be listed on the Hong Kong Stock Exchange. So this will be a major catalyst for Hong Kong Exchange going forward in terms of its revenue, its income. The second catalyst, I regret to say that because MSCI has ceased its cooperation with SGX and has moved its futures products to Hong Kong EX. Expected launch will be in the third quarter. So this will be another major catalyst to Hong Kong EX with more MSCI futures product to be traded on the Hong Kong EX. And also the third catalyst, which lead me to be upbeat on the outlook of Hong Kong Exchange is now Hong Kong's bull market. If it's a bull market, it's still at a very preliminary phase. We've not yet reached to the peak of the bull market, whereby the index saw new highs and the volume rose to very hefty levels. No, we are still far from that. So however, with the two catalysts I mentioned just now, the share price already soaring. So I think it's still a buy, but maybe because the share price has soared a bit too rapidly over the last 2 weeks. So we can wait for the share price to correct, say, to around $300. Before the breakout, $300 is a key resistance level. So after the breakout, this key resistance level has become a key support level for a share price. So 290 to 300 would be a preferred entry level. My medium to long-term price target for Hong Kong EX. I wonder if you know the stock code of the stock ticker of Hong Kong EX. Hong Kong EX stock ticker is 388. So my share price target is 388 for 388. 388 Hong Kong dollars for stock ticker 388 Hong Kong Exchange. And I hope that can materialize in the future. So thank you very much. Thank you for your time, and I wish you a very happy weekend and stay safe and healthy amid the pandemic. Thank you very much. See you very soon. Thank you.